Hello, it's Jeffrey Christian from CPM Group. I'm recording this around 3:30 on Wednesday, the 5th of October. We plan to release it on Tuesday, the 11th of October. I have the wrong date here, 10th of October on the presentation. I want to talk today about gold and silver in optimized portfolios. What's the role of gold and silver in a portfolio that has the best risk-reward ratio? We've used these charts before, and we'll use them again. It's basic data. Most financial analysts and institutional investors work off of a model portfolio created by Ibbotson and Associates in the late 1970s, early 1980s. Ibbotson had actually done this looking at gold prices from 1968 to 1980. And at that time, the risk-reward profile that was optimal, the level at which you had increased the returns more than you had increased the risk by adding gold to your portfolio, was about 5 to 10%. CPM Group has updated this repeatedly, and we've updated it, I guess, most recently through 2021. I believe this data is actually through 2021 and not 2020. But it's pretty much the same because you're looking at such a large period of time. And what you're looking at here is a chart that plots the risk, the standard deviation, across the horizontal axis and the return of a portfolio on the vertical axis. And you start with a portfolio that is 50% S&P 500 and 50% T-bills. And then you start saying, okay, well, what if I add 5% to my portfolio in gold? So I now have 5% in gold and 47.5% in the S&P and 45% in T-bills. And what does that do to my return over the long run? Historically, past performance doesn't indicate what future performance will be. But 1968 to 2020 covers a broad swath of the kinds of things that happen economically and financially. And you see, as you add that first 5%, the risk actually goes down in the portfolio. The portfolio's volatility actually declines. And the return rises. And as you keep adding 5% increments, and you look at this on a rolling average basis over the long run, you see that from 15%, even at 20%, you're increasing the returns and you're reducing the risks. As you go beyond that, you start increasing the risks as well as the returns. And at some point, around 30%, you're actually now increasing the risks more than the returns. So the optimal portfolio from 1968 to 2020 would have had 25 to 30% of its assets in gold. That's an astoundingly high number. And people who remember the Ibbotson research from the 1980s when it was 5 to 10% are surprised that it's so high. But we've seen a lot of things happen since 1968. Now, this is the way that financial professionals look at gold's role in a optimized portfolio. And it's come up recently because some people have come up with different figures for silver. So this is gold, optimal portfolio content, 25 to 30% over the last 53 years. If you look at silver, you don't have that first spur. You start and you increase your risk as well as you increase your returns with the first 5%. But you do have a sweet spot of 5 to 10%. We have two lines here. The bottom line is S&P 500 and T Treasury bills and silver, and the top line is S&P 500 index T bonds and silver. So you're actually looking at higher returns with the bonds and the bills. But in both instances, your return rises more than your risk increases in that 5 to 10% range. So it really makes sense that you should have 5 to 10% of your portfolio in silver. Now you can get all cute and say, well, what percentage should be silver, what percent is gold? But let's keep it simple. Stocks, bonds, gold, stocks, bonds, silver. And again, this has come up because some people have been talking about what the optimal role of silver is in a portfolio. And they didn't use the kind of analysis that institutional investors like to see, which is sort of this. And so some people have asked us to address it. And we've addressed it in the past, and I'm sure we'll address it in the future. This is a chart I wanted to throw in. We've used this chart too. This is the long-range portfolio performance of gold prices and the S&P 500. And there are 4 lines. The bold blue line is the nominal gold price, indexed 1968 through, I guess, about 2020, 2019, 2020. And the lighter gray line is the nominal S&P 500. You can see that there was a period of time, 1997 through 2001, when the S&P was actually at a higher base on this index basis, higher levels than the gold price. But that over the vast period of time of 63 years, 53 years, you've seen gold prices outpace S&P on a nominal basis. The 2 lines at the bottom, the bold line is the real inflation-adjusted gold price, and the yellow line is the real inflation-adjusted S&P 500. And again, gold outperforms the stock market, except for that one period of time, 1997 to 2001. Just cute stuff. But that's just buy and hold. You can do a lot better. And again, we've showed you these charts. These are CPM Group's intermediate term gold recommendations. These are not short-term recommendations. These are for investors with a 2 to 3 year time horizon. And we start in December 1980 when we started keeping track of our track record, our buy and sell recommendations. And in December 1980, gold price was down to around 600 some odd dollars, having touched 850 briefly in the first quarter of the year. We were in a recession. And when somebody asked us on the first business day of December, buy or sell gold, we said sell. And I guess the price was $595 an ounce. From 1980 through 2000, we were telling people don't buy gold if anything goes short about 68% of the time. In November of 2000, we issued a buy recommendation. We kept that in place until January of 2012, when we said sell. When the price got down to $12.11 in April of 2013, we said buy, and we've kept that buy recommendation ever since. And again, you've seen this stuff if you watch our videos, but we'll show it to you again. And if you haven't seen it, you should be fascinated by this. This is 3 hypothetical portfolios. The first one is you bought gold first trading day of December 1980 when we said sell it, and you held it. And you'd have an annualized rate of return of 2.75% over the ensuing half century. If you had just bought gold when we said bought gold and moved your money into treasuries when we said sell gold, you'd have about an 8.9% return annualized. And if you went long when we said buy gold and went short gold when we said sell gold, you'd have a 12.9% return. So yeah, it's great to own gold, to buy it, put it under a bushel, bury it in the backyard. But it's also good to have some sort of intermediate term view for some of your gold and trade it back and forth depending on where we are in the economic cycle and the political world. Similarly with silver, December 1980, we said sell. From December 1980 into about 2005, we were going back and forth. Most of the time we were telling people don't be long. 2002 or so, we said buy gold or silver. We were a few years ahead of time. The price did start rising slowly, but then it took off after 2005, 2006. We said sell it on at the last week of April 2011. And then we only said to buy it again, I think it was in 2019. If you look at the relative returns there, if you had bought the silver in December 1980, you would have an annualized return of 0.25%. Just seems like silver never went to $500 an ounce or $10,000 an ounce or $15,000 an ounce, the way some people thought. If you had just gone long when we said gone long and moved into treasuries when we said sell, you'd have an 11.8% return. And if you had bought and gone short, based on our intermediate term recommendations, you would have an 18% return over the last half century. So again, it makes sense to own gold and silver. It makes sense to have a portion of your assets in gold and silver. And it also makes sense to have a portion of your assets that are buy and hold, but also another portion that you trade in and out in an intermediate term basis with a 2 to 3 year time horizon based on macroeconomic conditions, political conditions, conditions in the silver market and such. That's all we have for today. You can see and read and buy our research at our website, cpmgroup.com. You can send us requests for information about how you can plug into the CPM Group as an investor and buy our research and advisory services at info@cpmgroup.com. Take care. Take care of those around you and the world at large, and we'll talk to you next week.